That sound is working. Good morning, everybody. Let's get rid of that. Let's pause this. System's a little finicky today. Good morning, August 27th, 2024. Mornings with Scott. Live. I tell you, the best damn, should I put my notes to the top so I know what I'm talking about? The best damn business show for medium and small businesses on the planet. Is anyone else offended by LinkedIn, sort of these cold emails? If you're a professional or in business on LinkedIn, you get these, I get 10 a day of people wanting to connect. And I just accept everybody because I'm not trying to screen people out. And it's usually for marketing. It's usually for, we can get you more views on your content or what have you. And that's all fine. That's the business these people are in. But then what it does is it immediately goes to, so if you want to talk about it, you can click on this link, which will take you to my calendar, and you can book a time on my calendar at your own initiative. Like, I can go out of my way and use my time to book something with you so you can give me your cold call pitch. Drives me insane. And it's just over and over and over again. It's the Gary V lingo, straight to the right hook. No jab hook. Nothing like that. There's no adding value first. Maybe someday we'll talk about a strategy on how we ought to deal with that. I don't mean the recipient, but if you were in the business of trying to get people's attention in LinkedIn, you should approach this differently. Anybody who sends me a jump on my calendar, I don't want to talk to them anymore. I'm done with that. I'm out. Yesterday, I had a discussion about David Sachs. Remember his post on X? And I told you, if you don't know, many of you know already, David Sachs is quite a famous these days, well-followed, high-profile technologist and venture capitalist. He's part of that PayPal mafia in Silicon Valley. He put a post on X that we talked about, showing that Republicans and Democrats and independents all view the mainstream media differently. I don't have their trust of the mainstream media. I don't have the stats in front of me, but Democrats had sort of a 73% trust level with the mainstream media, and Republicans were down to like 10%, and independents were way more down with the Republicans than otherwise. And so when I do my notes for this in the morning, for this show, I have my stories. I have a brief outline of what I think I want to do the night before. Otherwise, I run out of time in the morning. And then I do my notes. And I also write my title. So, episode 267 and, the title on that and my bullet points that will go into the notes, because on the StreamYard platform that I use, that's just kind of the way it works. And I do my hashtags. And so I look through in the morning. So the last thing I do is normally around 8:15 when I'm doing that. I will go live at 8:30. So I, hashtag, I'm talking about this David Sachs, who's got quite a following, deservedly so. And so I have a hashtag David Sachs, SASCKS. I'm spelling it because it's relevant to the story. And then what happens is this goes out live to the various platforms: Facebook, LinkedIn, YouTube, X, and Instagram. And then it's chopped up by the marketing team and put out on, there's many shorts that go out during the day from this content, including on TikTok. I would do live to TikTok, but the StreamYard doesn't seem to facilitate that yet. And so I put this on TikTok, and what the marketing people do is they take those same hashtags, and that's kind of their notes for the shorts, just the hashtags part. So there's a TikTok that goes out of me speaking, and it's got a hashtag in it, David Sachs. And so I'm looking at the TikTok yesterday, and they removed it. It has a pop-up note that says you've violated community guidelines, and we removed the hashtag Sachs. And so I was like, I don't understand. And so I started thinking about it, and then I have a little chuckle to myself. Anyways, I appealed and I won. They reversed that kind of right away. But the point is that if your name is Sack or Sachs, TikTok may behave like Bart Simpson and ban you. They just may think it means something different entirely. Stacks. Speaking of social media, yesterday, X, post on X by Grant Cardone, the relatively famous social media real estate investor, author, coach, personality. Love him or hate him, he's the guy that does that sort of work, probably the top of that food chain. He did a post on X yesterday. It says, it's always been my dream to become a public company and share the profits of my efforts with the public, including our employees, customers, fans, supporters, and those who just watch but never transact. I'd like to share my profits with you. If I were to go public, should I do an IPO or do a direct public offering disclosure? This is not an offering. So that's a post from Grant Cardone yesterday. So again, for context, apart from his online coaching, aggressive sales tactics, author of Being 10X, that's a business book that he put out, 10 letter X. Grant Cardone is a prominent prominent figure in the real estate investment world, focuses on large-scale multi-family properties. His real estate portfolio is valued at over $4 billion. I don't know if that's true, but that's what the internet says. It spans multiple states across the U.S., makes him one of the largest private multifamily real estate owners in the country. He legit has a big business and seems to be doing very, very well for himself. So congratulations on that. He raises money from the public. He raises money from you, both accredited and non-accredited investors. So accredited is a type of investor when you're selling a security that's qualified to buy that security because they're wealthy, and so it's not a high risk thing for them, or because they're sophisticated and it's not a high risk thing for them. The securities regulators assume that if you have some money and you're trained in certain areas, well, then you know what you're doing. And so you become accredited, and then the issuer of that security, in this case, Grant Cardone, doesn't have to disclose as much information. It's a simpler process. On the other hand, there are non-accredited investors, and that's people that don't have that level of wealth or that level of sophistication, whatever that may be. In some jurisdictions, it's like 150 grand. It's probably more than that these days. I'm not going to drop a number. I haven't paid attention lately. But the back in the day, it was like 150 grand, I think, in a lot of jurisdictions to become sophisticated or accredited. And so he also sells to non-accredited investors, which requires a much higher level of regulation and disclosure. And so, but anyways, he sells to basically everybody, even those who are not sophisticated, and he charges a bunch of fees to those investors, obviously. So basically, you're going to go buy a building, you set up a multifamily building, you set up a project, and then you sell units in that project or whatever the security is. I'm going to call it units for lack of having done the research on this. And you charge a fee. You charge an acquisition fee. Like, hey, we went off and we found this deal. We're going to charge you X percent. You charge a management fee. Someone's got to do the reporting and the management and all that sort of stuff related to this property. So there's a management fee. There's a performance fee. Hey, if I make a bunch of money on this for you investors, I get a little bonus, right? That's typical. Administrative fees, every kind of fee. I don't know what the numbers are, but I've read that they're pretty high. I know that some of my listeners are investors or at least follow Grant Cardone's products. So maybe you could tell us what the fees are. So I do know this, however. There's all sorts of allegations that he front runs the acquisitions and resell. So what does that mean? Front run the acquisition. So there's a building over here. It's got a bunch of units, as I said, and he wants to buy it and he wants to finance it with your money. All right. So that's fair. That's sort of a legitimate business, could be a GP/LP structure, whatever it is. But instead of doing that, instead of setting up the structure, getting the money, going to buy the building, which is what you think is happening, what he does is he goes and buys the building himself, sets up the structure, gets the money from you, sells the building from himself to the structure at a profit, and then starts taking all the fees for the privilege. So they call that front running, or at least I call that front running. I guess that comes from the securities trade, but I think that's relevant industry, but I think that's relevant to this real estate trade as well. So there's all sorts of allegations of that. He also, you know what, I was thinking about this yesterday, and I don't follow this guy well enough to know what he does legit. So I thought, I wonder what you would do if you were being super aggressive and a little bit scammy and you wanted to make a bunch of money on this. Oh, I know what you do. You'd have your own property management company on the side, and that property management company would provide services to your own projects. You, the investor, are funding that, and you'd make a pretty good margin at the property management company side. Well, yep, he has a Cardone Property Management, or whatever the name of it is, and he provides services to his own projects that you fund at, let's assume, a pretty good fee. And I thought, what else? And I looked in the research, asked the AI. What about a construction company? Does he own a construction company? Because a lot of this stuff is you buy the building cheap, you do some renovations. He's always on Instagram walking around like, hey, I got to fix the waterfront. And so he's doing that. And yep, sure enough, Cardone Construction. So he provides all the services that are required. You would normally go to third-party contractors. You get the lowest bid. Do you think he's the lowest bid? Do you think he's the lowest bid on his own deals? Or do you think as his investor, you're overpaying for this stuff and he's making a fortune on the back end that has nothing to do with the real estate project itself? It reminds me, I used to own, I was in the, how do I phrase this? I used to own a franchise business. Not on purpose. I didn't start it. I bought it as a troubled business, and this was one of my failures, a colossal failure. I don't get those too often, but this was definitely one of them, I'm ashamed to say. And the franchisor, which is what I own, had a number of franchisees, and they were bakery, cafes, like, yeah, coffee shops, bagel shops, baked goods, that sort of stuff. And walking into that business to turn it around naively, I thought, well, you make your money how? Franchise fees, royalties, marketing fees, transaction fees. Like when a new franchisee comes in or someone wants to sell their business, there's money associated with that. So there's a bunch of fees, and there's a parallel to the Grant Cardone real estate syndication. You think, oh, well, this guy makes his money from management fees, transaction fees, success fees, in a sense, like fund management, like a hedge fund person. You would think that, but that's not where the franchise makes its money. I learned where it makes its money is it sells 100% of everything to the franchisees at a ridiculous price. That's what it does. So as a franchisee, you've paid for this privilege, you're paying all your fees, and then you go turn the key in the morning, and everything you do is supplied by the franchisor, and under the air quote premise of, shall we say, purchasing power, because I can buy it cheaper than you. And that's where the franchisor behind the scenes is making a ton of money. This Grant Cardone thing seems like the same deal. He's got all his fees, but he's also got property managing construction company. And that's just what I thought to look up. I mean, I didn't see that anywhere. It just occurred to me this might be the case. And I found the company names and et cetera in about 2 minutes. What else does he provide? Does he provide insurance? Maybe he couldn't pull that off. Does he provide his own financial leverage? Maybe he does. I don't know. It'd be interesting. So all of that is really aggressive on his part, but I don't know. I'm not a lawyer in the US. I don't know the securities laws inside and out. I think it's aggressive, but probably fair game, as long as there's full disclosure. I think that if you're an investor and you want to invest in his deal and he says to you, hey man, hey, I bought the property first and then I'm flipping it into a deal and I'm charging you a markup, and I had a good reason for doing that because I found the deal and I had to buy it that day and I got the cash, so I did. And so there was a value to you as an investor. Okay, I'm not an expert, but I think that's probably all fair game, although there's lots of lawsuits against him for sure. And most of those lawsuits are because of misrepresentations on returns. Hey, on your social media, you said I could be a billionaire, and my returns sucked, right? So that is what he does for a living. There's the background. So he puts out a post and he says it's always been his dream to go public. Well, what would happen? What would happen? I think we should all understand this as business followers. What would happen if he's went public? Well, I mean, we don't have to guess. We see this over and over and over again with his personality type in his industry at this level of aggression. Here's what's going to happen. He's going to go public. It's going to be very successful because he has lots of retail followers. So the institutions may not buy in; they might find it a little sketchy, but there's lots of you and me's out there, and we're going to go buy some stock, and it's going to be a successful IPO. And then within about a week, someone from New York probably is going to put a huge short on that stock. In other words, they're going to sell the stock in hopes that the stock goes down. And then they are going to cover it later, cover their short. So they're going to go buy the stock in the market sometime in the future at a lower price. So they sold at a high price, bought at a low price. And that's the way they short the stock. And when you start selling the stock on the short, what happens is you're driving the price down, right? Supply and demand. So it's driving down. The next short comes in, you're shorting, the price going down and down and down. And you would think, well, if this is such a good deal, how could they drive the price down? Well, what they do in conjunction with that, these short people, is they go to their buddy across the road who has a, air quotes, independent research firm, and he does a short report. That's my lingo, not their lingo, but a research report on the stock. And they say, oh my goodness, he owns a property management company, he owns a construction company, he's front-ending this stuff. This is a fraud. This is a fraud, or maybe it's a fraud. That's what they will allege. And then that report will go out to the investment community world. The Wall Street Journal will pick it up, and all of a sudden, Grant Cardone is in trouble on this research report, and the stock will drop further because now you and me as retail investors were reading the Wall Street Journal and we say, holy crap, I'm in this stock. This doesn't sound good at all. I'm going to get out of this thing. And so now we start selling as well. Nobody's buying. I mean, if we didn't own the stock, we're not obviously selling it. But if we don't own the stock, we're not going to buy it. So the supply demand balance goes out of whack. Stock goes down. And now the lenders start to get nervous. They're like, hey, Grant, what's going on? Your stock dropped from $100 to $3. And we want to call all our lines. Well, yeah, I could sell the Gulfstream. Yeah, it's a problem that we see over and over and over again. So I responded to the tweet. I said, the worst idea ever in your business, one-way ticket to death. That's what I responded. I got a like from Grant on that, so that was kind of cool. Look at, you got to know what you're getting into. Some businesses can be public. Some businesses can't. Some businesses should be invested in. Some should not. Know the difference. This money management syndication business is not a good. It's not a good public company business. Don't get into that. We had an example of this, by the way, in Canada with a large lender, similar personality type. Was his dream to take this thing public. It was just knocking out of the park. This thing was spitting out cash like you wouldn't believe. And then he goes public, and then that's exactly what happened. That short sale, independent, quote unquote, research reports, and then there was internal pressure to, not take losses because quarterly reports coming up, and it just became a beast in and of itself and ended up going out of business. That's what happens. That's what will happen to him. Remember last week I reviewed an opinion piece in the Globe and Mail, Canada's Wall Street Journal, by some moron from a Canadian university that I don't recall, who was basically arguing that Canada can't match US tariffs on Chinese-made EVs. Not that they can't, but they should not match Canada's the U.S. tariffs on Chinese EVs. So the U.S. Had put a 100% tariff on electric vehicles coming from China. Canada was considering that. And this guy wrote a whole essay saying, We should not do that because we would turn into, in Canada, if you're part of the we would turn into East Germany without competition. And he went on at length about East German cars. And then when the Berlin Wall came down, the East Germans figured out their cars weren't all that awesome compared to the Mercedes and other German vehicles. So I pointed out that this guy had a lot of political bias. When you look at his background, he's probably a paid Chinese stooge in a Canadian university. And that more importantly, he's wrong. He's wrong that there was no way that Canada was going to break from the US on electric vehicle tariffs because there is no Canadian auto industry that unless it's fully integrated with the US. The US is the market, which is why they're going to win on tariffs in the short term because the customer is always right. They are the market that brings all the power. And there's no way in hell that if anybody with any one brain cell in Canada thinks about this, there's no way in hell that they're going to break from the US on this tariff idea. We are in the automotive sector, it's too integrated of an industry. Throw in the comments if you think I'm wrong, but I don't believe that I am wrong on that. So Bloomberg reports that Canada announced Monday it is launching a 100% tariff on imports of Chinese-made electric vehicles, matching the US tariffs imposed over what Western governments say are China's subsidies that give its industry an unfair advantage. There you go. You heard it here first. The announcement came after encouragement by U.S. National Security Advisor Jake Sullivan during a meeting with Canadian Prime Minister Justin Trudeau and cabinet ministers on Sunday. I think they're burying the lead here. The breaking news is that Justin Trudeau worked on a Sunday. I'm skeptical. Are you skeptical? I'm skeptical of this story. Trudeau said Canada also will impose a 25% tariff on Chinese steel and aluminum. Actors like China, have chosen to give themselves an unfair advantage in the global marketplace. Canada has had anti-dumping duties against Chinese steel for quite some time. They come up for renewal every now and then. Last year it was up for renewal. We had to, one of my companies, make a submission to support the reasoning behind that. And so this is part of that, a 25% tariff on Chinese steel. All right, there's that part of the story. We've got perfect timing here for our segment that I haven't done in a while, but I need to get back to it because these were very valuable to you. I know that from the feedback that you give me largely privately. And that segment is financial literacy for business. What is financial leverage, or just leverage? Financial leverage refers to the use of borrowed funds, debt, to finance the acquisition of assets or investments. So leverage, people just call it leverage, but there is such thing as operational leverage. There's other types of leverage. So I'm saying financial leverage to distinguish, but going forward in this little segment, I'm just going to say leverage because that's what business and financial people think of when they use that term. And so the idea is you're using other people's money, debt, to increase your purchasing capability and also to amplify your products. So in other words, I want to buy a machine. I don't have enough equity money to do it myself. I say, oh, I can use 10% equity money and go borrow 90% from a bank or what have you. That is leverage. The debt piece of that is leverage because it's leveraging my capabilities and hopefully it's leveraging my rate of return. The math on leverage is pretty spectacular in both directions. It increases the risk of losses if the investment does not perform as expected. The amplified return happens because the hope is that the return on the investment, let's call it 15% on whatever the investment is that you're making. If you borrowed the money at 10%, well, there's a 5% profit just on that, just on the debt trade itself. And what nobody tells you about, hey, good morning, Ion, thank you for joining. What nobody tells you about from leverage is that you're using the debt because you don't have enough equity or you don't want to use your equity. And people think equity is free, but it's not. The equity is way more expensive than the debt. The equity in your business is probably, if you were a business valuator like myself, you would say it costs 20% or 40% or some larger number, depending on the risk profile and size of your business. Look at, you think about it, leverage simply, think about you own a house, just your personal residence, and you put 20% down and you have an 80% mortgage, right? Well, the mortgage part is debt. It is leverage. If you had to put 100% down out of your own pocket, you could not afford to buy that house, right? So the number one advantage of leverage is it gives you more access to capital to go and buy that asset. And then if the house goes up a little bit, right, over time, as you live in it, your returns on your 20% become really significant, right? And the returns on the because your mortgage is still fixed at that number. Say the 80% is $800,000. Well, you still owe, the house goes up from $1 million to $2 million. You still owe $800,000. The rest of that goes to you, and you only put the 20% down, which in that example, right off the top of my head, was $200,000. So you get hundreds of percent return on that equity investment. Understand what I mean? So the benefits of leverage are greater access to capital, as I just said. And secondly, the increased potential return, as I just said. And remember that one thing to remember is that you don't have all the money. That's why you go to borrow it. And number two is your cost of equity in your business is super expensive. And you think it costs nothing because you pay an interest rate on it. Because you do not pay an interest rate on it, whereas you pay an interest rate on the debt. But that's not true. That's not true. Apples to apples, your equity is probably, as I said, 20, 30, 40% cost of capital, and your debt is whatever the debt is, 10, 12%. In my world, I don't mean my borrowing, but I mean with the companies that I often work with. And so, or cheaper for larger businesses. So there is a comparison of that. And don't forget on leverage, if you have debt, you have tax advantages. This is a business example. Could be a personal example on your residence, depending on your jurisdiction. But in business, often you go buy a piece of machinery, you buy real estate, and you borrow money to do that. Well, you can write off the interest on that. So that actually juices up your returns a bit more, the returns on an after-tax basis. But there are huge financial risks that go along with leverage. Leverage can amplify your profits, but it also equally amplifies your losses. If that house went down, it doesn't wipe out the debt first, it wipes out the equity first. If the investment in your business doesn't pay off, same thing. It wipes out the equity in that investment first. And if there's no equity, if it was just 100% debt, well, the lender doesn't care. They want all their money back. So you are taking a significant loss. High levels of debt, if you have too much leverage, increase the risk of insolvency, especially the company's income drops and you can't meet your debt obligations. Yeah, here's something that people don't often think about. I was doing a debate with Tom Clausen, I think, on somebody else's podcast, and debt versus equity. And I made the point, and I stick to it over and over and over again, is you literally, technically, you cannot go bankrupt unless you have debt. If you don't have debt, you can run out of money, you cannot eat, you cannot pay your rent. All that can happen, but you need a lender to bankrupt you. That's a fact. You need to owe money to people to go bankrupt. Leverage creates that scenario, and if you get into trouble, you're at risk of insolvency. That is leverage. Leverage is the fastest way to wealth, 100%. It's also the fastest way to the poorhouse. It's high risk. It literally levers what was going to happen. Anyways, that is leverage and the financial literacy for business segment. I'm running out of notes here, I think, and my timing is perfect. Hey, go buy my course, the pre-sale on my business course to help you earn more profit, raise business capital. It's super cheap right now, like the yen carry trade, says Mr. Stevens. Yeah, yes. Yes, that's exactly what it's like. I can't talk about that in 10 seconds. That's a more interesting topic. I should probably cover that someday. Go buy my course. The pre-sale ends this week, August 31. So if you want it at its cheapest level, you can go do that now. And this time, I promise, I put the link in the notes. So you can go do that. You could do it right now. You could just hang up from this call, stop listening, go get your credit card, and go to thescottsinclair.myshopify.com, and you will be good to go. Get that done. Thank you. We will talk to you tomorrow, 8:30 Mountains, Monday, Tuesday, Wednesday, Thursday, Friday.